Are you ready to make the most of your oil and gas mineral rights? Welcome to the Mineral Rights Podcast. Get the knowledge and resources you need to manage your minerals and royalties. Here is your host, Matt Sands.
Hello and welcome to the Mineral Rights Podcast. I am your host, Matt Sands, and I'm here to help you make the most of your mineral rights and royalties. Thanks for joining Justin Williams and me in this episode. And today we are speaking with Bob Howard and Taylor Leander from Resource Royalty LLC about 1031 exchanges and how mineral interests can fit into this strategy. As you may know, a 1031 exchange is a strategy that is defined under Section 1031 of the IRS Code that allows an investor to defer paying capital gains tax on certain types of investment properties when they are sold, as long as certain conditions are met. This episode was recorded before the impacts of COVID-19 and before the price of crude oil tanked in early March. Now, that being said, this topic may actually be even more important in helping to maximize your return on investment, especially considering the challenging market conditions we are faced with in 2020. So the timing of this episode was originally intended to correspond with the traditional tax filing deadline of April 15th. But obviously in 2020, the federal government has pushed that back, at least in the United States, to July 15th. So that said, this is still something to keep in mind as you're preparing your taxes. And now, let me tell you a little bit about Bob and Taylor before we get started. So, Bob Howard is the co-founder and president of Resource Royalty. Mr. Howard spent 30 years in the investment industry with Merrill Lynch, Lehman Brothers, and Deutsche Bank. And Mr. Howard's career began in Tulsa, Oklahoma with Merrill Lynch and took him to New York with Lehman Brothers. And he has spent the last 20 years in Dallas. In 2006, Mr. Howard retired as a managing director of Deutsche Bank in Dallas. And as a native Oklahoman and an oil and gas investor for many years, Howard blends his investment background with his personal experience as an oil and gas investor. Mr. Howard's investment advisor background with Wall Street firms gives him the natural understanding of dealing with investor clients and their requirements. Throughout his career, Mr. Howard's investment approach included an allocation into various alternative investment strategies, including hedge funds, real estate, and oil and gas. Mr. Howard currently receives distributions from several oil and gas offerings, which makes him an investor as well as an advisor. At Resource Royalty, Mr. Howard leads the acquisition team and is in charge of capital formation. And Taylor Leander also joins us as the Director of Investor Relations and Marketing for Resource Royalty. And as a native Houstonian and spending his childhood in Anchorage, Alaska, Taylor developed a passion for the oil and gas industry at a young age and has been surrounded by the industry his whole life. He joined the company in 2014, and during his tenure at the firm, Taylor has raised millions of dollars in private capital and has emerged as an accomplished and driven financial services professional with a proven track record of building and retaining relationships with top-producing financial advisors and industry professionals and high-net-worth investors. Mr. Leander received a Bachelor of Business Administration in Finance and Management from Baylor University and resides in Dallas, Texas as well. He's an active member of the Dallas chapter of the Young Professionals in Energy, the Baylor Business Network of Dallas, and Park Cities Baptist Church. Now, I just want to say one thing before we get started, that this conversation is being shared for informational purposes only. As always, you should consult with your CPA and or attorney regarding these and other tax-related strategies. And in this case, the powers that be would like me to remind you that this is not an offer to sell. As always, you can find the links mentioned in this episode in our show notes at mineralrightspodcast.com. But for now, let's just dive in because we have some really useful information to cover. Thanks again, Bob and Taylor, for joining us on the Mineral Rights Podcast. I'm really excited to have you on the show to talk about the ins and outs of 1031 exchanges. So, welcome.
Thank you. Thank you.
Thank you, Matt. Pleasure to be here with you this afternoon.
Yeah, thanks for taking the time. So, Bob, let's get started at the beginning. Can you please tell us how you got started with investing in oil and gas? And I mean, does your family have a history in the industry, or how did that come about?
That's really kind of a funny question because uh, 2 weeks after I graduated from college, Westminster College in Fulton, Missouri, I was working at Merrill Lynch in Tulsa, Oklahoma. But I grew up around oil and gas my whole life in Tulsa. My grandfather was exploration manager of Sunray DX, Mid-Continent. He office on South Boston and Tulsa. So I was around this stuff, since the 50s. I chose not to go into it directly, but I had an opportunity shortly after starting in the investment business to move to New York. And I remember these guys would say, "What does this mean?" And they were talking about downhole pressures and tubing and fracking and all sorts of things. And I just realized I really knew a lot more than I had thought. And as you know, growing up around the oil business, you just kind of know these things. So um, I spent 30 years in the regular investment business, the last 25 of them in Dallas. And after I kind of decided to switch directions and kind of semi-retire about 12 years ago, I live in a neighborhood that it seems like every other person is making a fortune in the Barnett Shale at that time, back in '06 and '07. So I knew darn well that the easiest and maybe the best thing to do is not to drill the wells because I don't have tens of millions of dollars, but to buy the minerals, buy the royalty, and have engineering done and make sure that you've got the right type curves and wait for them to come drill on your property. So I joined an experienced independent oil man here in Dallas in 2010. We formed Resource Royalty. Since that time, we've offered 14 different portfolios that we have acquired the mineral interest in just about every basin that everybody knows about. We are not quite as diversified now. We're really just in the top basins where they're still drilling. So that's kind of a background on it.
Yeah, it's come full circle. So it's really interesting to hear. So you mentioned a little bit about the background of resource royalty. And I know that you guys have some good information on your website about what minerals and royalties are as an asset class. So, and I know our listeners are very familiar with that already, but many may not realize that minerals and royalties qualify for a 1031 exchange, or they can. For those listening who may not be familiar with a 1031 exchange, can you talk a little bit about what it is?
Absolutely. It's important to understand that minerals and royalties, of course, are deeded real estate according to the IRS. And that means that they are like kind. So they are like kind, just like an apartment building or a condo on the beach that might be held for any sort of commercial purpose. 1031 tax-free exchange is not available for your primary residence, but if you own a ranch, if you own an apartment complex, whatever it may be, the way these real estate guys have done so well for years and years and years is they've never paid tax on their gains, unlike stock market investors or people trading in any other type of asset. So the beauty is that if constructed properly, you can do a 1031 exchange out of commercial real estate into royalties, back into commercial real estate, out of commercial real estate into royalties. I mean, it's never ending because it is a like kind exchange.
And that's an important element, like you mentioned, that like kind aspect. I know, and you mentioned the different types of like kind properties. Are there any others besides the Commercial real estate, I think most people are familiar as an investment property. You mentioned royalties, or what other properties are considered like kind?
So there was a tweaking of the tax law a couple of years ago, and they tightened up the definition of like kind. Prior to this change in the tax law, a lot of different things could be like kind, including trucks used for the purpose of hauling gravel around. You could trade those trucks for other trucks. So there was a much broader definition of like kind, but really it is far more to do with deeded property. So that's why we feel so good about it, and at least half of our business, if not more, comes from people that involved in a 1031 exchange. So it's a tighter definition. um, I want to jump ahead. You're probably going to ask this question, but the folks that really know all about this are the intermediaries that you're required to use. You can't just go find some minerals and do some swap on your own. There has to be a qualified intermediary known as a QI that actually handles the closing of all of that and the transfer of money. Many times these are title companies, and if they're not the title company themselves know a great deal about it. So some of these specifics that you're asking about 1031, the QIs know all of this, in fact, far more than I know.
So, a normal investor, if they're looking at doing a 1031 exchange, is it not something they can do on their own without any help then?
It is just like any other sort of real estate transaction. There is a closing process. And just like you use when you close your house or any other commercial real estate through a title company, in this case, it's the qualified intermediary. So before moving ahead, you want to find a local QI, and they are all over the place. We don't have one that we work with, we have dozens from all over the country because business comes to us through investment advisors primarily. So if people have questions about the 1031 process, the first thing they want to do is call their kind of the local title company and ask them if they operate as a qualified intermediary, and they will immediately know what you're saying. They'll say yes or no, and if they don't, there's somebody down the block that probably does.
And I didn't know that. That's interesting. So, if somebody's looking at trying to find a qualified intermediary that's familiar with minerals and royalties, is that sort of a prerequisite that you recommend, or is it sort of any qualified intermediary that is familiar with the like kind exchange and the whole 1031 section of the IRS?
So I think your question is kind of like, does every QI know that minerals qualify for 1031? And that is a very keen question because those folks in Southern California that we do business with many times are not that familiar, and so we have to educate them a little bit. Uh, we've got our own opinion letter written. It's very straightforward, and with a little bit of education, the QI can do it. But if you happen to be in the oil and gas regions that I suppose a lot of your listeners may be, then I think a lot of those QIs would be familiar with this. Let me point out one thing that is very key to executing a 1031 trade in this is you must have the properties identified. You can't just kind of shop around. So in other words, let's say you're selling an apartment complex and you're selling it for $6 million. You go ahead and you close that, but all the proceeds from that must then go to the QI. They must hold those. If you receive $1 from those, you have negated or kind of broken your 1031. So what you want to do is you want to shop around and figure out what you want to do. And by the way, you can split up your money. Let's go back to the $6 million example. Let's say you want to put $3 million in minerals and another $3 million in some other commercial property. You can certainly do that, It just all has to go through the QI.
Got it. So QI, you're looking for a QI that's familiar with minerals and royalties, ideally, and then if not, then get some help to educate them to make sure that you're dealing with somebody that's going to be able to handle the transaction.
We probably deal with 20 or 30 different QIs because we do business all over the country, and if anybody needs any help in their particular region, we're happy to give them some names to contact.
Perfect. Okay.
When I know with 1031 exchanges, there are some strict timing requirements associated with it. What are some of the key timing milestones that property owners considering a 1031 should be aware of?
This is where I want to introduce Taylor.
Yeah, great question there, Justin. As Bob mentioned before, there is a very strict timeline that 1031 investors must follow. First and foremost, the investors must retain a qualified intermediary to take the proceeds from the sale and help facilitate the exchange. As we mentioned before, if the investor has physical possession of the proceeds from their sale, then they're going to be subject to pay the capital gains tax. So it's extremely important that they have a qualified intermediary before they begin this process. Once they have the QI identified and their relinquished property has closed, they have up to 45 days to identify a property or a number of properties that they intend to purchase. And then once that 45-day period is done, they have an additional 180 days to close on those properties. Now they can choose to only close on one of the properties, or they can choose to close on a number of different properties. They just need to make sure that they follow the strict timeline and close within that 180-day period.
No, I think that makes a lot of sense. And, are there other strategies available to people? I guess to me, thinking about this, having to have the property that you're wanting to buy lined up. I mean, do typically investors pick multiple properties and have them ready to go just in case? Or what are some of the other options other than just having that one property you want to purchase?
Yeah, absolutely. We see a lot of our clients identify multiple different properties. As Bob mentioned before, we syndicate these investment offerings through the independent broker-dealer channel. So we are dealing with financial advisors, registered investment advisors, and their accredited clients. So many times, these clients have specific needs that they're trying to fill, and they're trying to build a portfolio of various properties to kind of fit those needs. In many cases, they're using royalties as a way to diversify away from traditional real estate, right? If you're selling a property that has a high capital gain, most likely you're going to be purchasing another property at a high, right? Unless you're able to find some sort of rock and deal real estate deal, you're most likely going to be selling high and then purchasing high. So where royalties fit into that equation is we're providing individuals a way to step away from kind of the traditional four walls of real estate and step away from a very much overappreciated and overcrowded real estate market. Another feature of royalties is in many cases they are purchased without using any leverage. So they are all cash assets. So if an individual has debt that is associated with their relinquished property, they're going to need to find a home for that debt. Unfortunately, royalties are purchased with all cash, so we can't take on any of the debt. So they're going to need to find a home for that debt, and then they're going to have what is called a cash boot, the remaining portion. And in many cases, royalties in general are used to kind of fill that last little bit of cash boot.
No, I think this makes a lot of sense. And you touched on some of the advantages of using oil and gas interest as a replacement property. But what are some of the risks of using oil and gas, mineral, and royalty interest as replacement property versus maybe traditional investment property?
Yeah, absolutely. That's a great question. First and foremost, there is, with any royalty investment, some of your biggest risks are going to be lack of operational control, lack of control of commodity environments, production risks, et cetera, et cetera. So that's really the main risk that we see with using royalties in an exchange is really the same risks that any type of royalty investment carries.
This is Bob. Let me add one thing to that. It kind of depends on what your royalty strategy is. There are, just buying PDP properties that are fully developed. You have a pretty good handle on what that decline curve looks like. Your main risk there is just commodity price and perhaps exit value. We don't use that strategy so much as we try to be more of the one step ahead of the drill bit type of strategy, to where as new wells are drilled on our properties, we're going to experience that boost in cash flow from that. But in order to offset that being, purely something in the future, we also build a portfolio. Our typical portfolio will have somewhere between 20 and 50 different properties, and I'd say at least 2/3 of those will have some current production, and the other third would be near the activity, but maybe in the path of additional development. So what we want to do is try to minimize the risk of just being locked into a commodity valuation, like happened a couple of years ago. If you'd gone out there and bet gas was going to be 650 for the next 20 years and oil was 100, and bought all PDP, you're significantly underwater. But if you bought that same property with additional permits in place, or the opportunity for infill drilling, then you're going to have additional wells come online over time, which is kind of what we do.
No, absolutely. And that makes sense, trying to decrease the risk there.
You mentioned a little bit earlier some of the timing milestones, from in timing the exchange. I understand that you have to complete the exchange before the tax return due date. Is there a particular time of year that it's better to be thinking about completing a 1031 exchange, or does it really matter?
Well, I think you're always better off not trying to go into the new tax year. I mean, what we try to encourage people to do is have your properties, and by that I mean your commercial properties as well as your royalty properties, all lined up. Because if you sell your property and then you say, well, I've got 45 days to go out and find some new property, that's pretty hard to find everything you might like in that time frame. So we tend to work with people when their property is for sale. They kind of know the closing date. Maybe the closing date, is pushed back by 30 days. That's no big deal. But then they'll have our portfolio that comprises 20 to 50 different properties, and they say, well, okay, well, we're going to put $1.5 million over here in this resource royalty portfolio, and we're going to put $2 million over here in this apartment complex, another $1 million in this one. So you kind of want to have all of that planned out before you go ahead. It's of course always better not to do that over 2 tax years, if at all possible.
Yeah, that makes sense. Taylor, I want to circle back on another thing too. You mentioned the term cash boot. If it's what I think it is, it's part of the cash or contribution that's added to an exchange to make the value of the two different properties, or the relinquished property and the new properties, equal. Is that correct? And what do people need to look out for when the property values aren't equal?
So what you need to look out for is really you need to make sure that you find a home for all of your dollars. So if, like I mentioned before, if you have debt associated with your relinquished property, you're going to need to find a home for that debt. The cash boot is just the remaining piece of cash that's left over, and that's where royalties can fit into the equation. Is I have $100,000 of cash left over after I found a home for all of my debt. I can go ahead and purchase an all cash asset such as royalties.
Okay, that makes sense. And when you say a home for the debt, I mean, if somebody is selling a property and maybe they're looking to invest in something else, I guess is one option to pay off that debt and then invest the entire proceeds into minerals, or is that basically what you're saying? Either push that forward and buy and finance another commercial real estate property, and then use the leftover cash to then invest in minerals. But I
Mhm.
mean, can you?
More often than not, you're going to have, just as you mentioned, the second part of your question is you're going to have to go and finance another piece of commercial property, and then you're going to have the leftover cash portion to be able to play with it with an all cash asset like royalty.
Matt, let me expand on that. You can't tamper with all of that because then you have more of a taxable event when you do that. So, going back to our $6 million example, let's say you had $2 million in a mortgage with that. That goes forward with the transaction. You cannot pay that off, otherwise that portion of the 1031 would then be broken, and that'd be subject to tax.
Perfect. No, that helps explain it. Yeah, thank you. So, as far as resources out there for investors that are considering a 1031 exchange, where should they go to educate themselves first about the potential of doing this if it's something they're interested in?
Well, I would say they talk to their tax consultant first, and if their CPA is not familiar with this, there's a lot of stuff online just by simply Googling, 1031 tax-free exchange. We are the largest provider of portfolios for 1031 exchange within this whole arena of using investment advisors. Um, and one of the reasons that we are is it's complicated, and we have to assemble a portfolio that can be offered. So we don't do this, along the way based on each 1031. We have a portfolio that has been constructed, and then it's then offered, and people use that for a portion. I mean, we're going to offer anywhere from, you know, $8 million to $25 million portfolios, of which the investor can, if he chooses, recognizing the risks are involved, a portion or all of that. That way, it's kind of simpler for them to say, well, otherwise, it's very challenging to go out and create a diversified mineral portfolio if you've got a bunch of money. I mean, for a couple of $100,000 here or there, sure, you can go to EnergyNet and buy a few things off of there. But that's how we've been successful, is to create a portfolio that's already diversified between operators, geography, commodity, etc. Otherwise, it can become very challenging.
And there is a national trade association for qualified intermediaries that would be very helpful for a potential investor. It's called the Federation of Exchange Accommodators, the FEA. They have a whole host of different pieces of information, a national directory of QIs all over the country that's available to any potential investors. And there's also a number of large national QI firms that we have done business with in the past. A few that come to mind is Asset Preservation. Another group that we deal with quite a bit is called IPX 1031. But again, as Bob mentioned, there is just a whole host of different resources for the investors. A quick Google search for 1031 exchanges will be more than enough information for an investor.
That sounds good. Yeah, there's a wealth of information out there for sure. It almost can get overwhelming at times, I know. So I know that's where having a qualified CPA can come in really handy, just to help wade through all of that and give you the Reader's Digest version of what you need to know. So thank you again for all of that breakdown as to what you need to be considering when doing a 1031 exchange, and then how minerals and royalties fit in that. Are there any closing thoughts or anything else either of you would like to mention before we wrap up?
Well, I'll give you this kind of closing thought, because probably just about everybody's listening has some exposure to various asset classes within their investment portfolio. And many times we talk to real estate investors, as Taylor was mentioning earlier on, who've done very well. let's face it, real estate has been in a tremendous bull market, particularly here in Texas and other parts of the growth areas of the country. And royalties and oil and gas interest, as most folks on this line know, we have not been in a bull market. And so, unless your opinion is that there isn't going to be a need for fossil fuels in the next 30 years, I think it's a wonderful time to consider diversifying your interest out of a highly appreciated asset and into something that has tremendous long term value, particularly if you're buying properties that are not fully developed, as ours are, plenty of room for new wells. So I just throw that out there. I think you got a lot of smart folks listening to this, and people are scratching their heads and saying, what do I do with this highly appreciated real estate? Does it make sense to find something that is a solid asset? May not be clicking on all 8 cylinders today, but certainly has the potential to.
That's a good point. I think that, that you bring up about the current market, it is certainly a down market in oil and gas, and with commodity prices and with sort of the activity level today. So, it is you think about a buying opportunity, it's definitely got some upside to it. It's not like we're dealing with your earlier point, Bob, with $6 gas and $100 oil. So that is good. I mean, obviously there are associated risks with oil and gas that we've talked about, and certainly do your research, before you make any investment. But that is a valid point. So if people want to find out more about Resource Royalty, how can they go about doing that, and how can they contact either of you if they have any questions?
Resource Royalty is www.resourceroyaltyllc.com, and it's got all of our contact information in there. We'd welcome your conversations. Once again, the compliance folks would like us to tell you that we don't offer investment portfolios, but we do construct them, and they're then offered through a managing broker dealer, and all that can be discovered on our website.
Great. Thank you, Bob. And thank you, Taylor. Appreciate your time. This has been very informative. And, with tax season coming up here, I know a lot of people are looking at how to minimize their tax liability. So I think this is definitely a timely topic.
Thanks so much. Enjoyed chatting with you.
Yeah, thank you, Matt. I appreciate it.
Thanks so much for listening to the Mineral Rights Podcast with your host, Matt Sands. Don't forget to subscribe and share at mineralrightspodcast.com. The Mineral Rights Podcast should not be construed as investment, legal, or tax advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy.